Hello, everyone. Welcome back to another episode of Signal or Noise. This is episode 56. Charlie Bilello here, and with me, as always, Peter Mallouk. Peter, we got a lot of great responses from our last show, The Triumph of the Optimist, but a bunch of questions following that saying, yeah, it's great to be optimistic, and it definitely worked out this year and has always worked out in the past, but isn't this as good as it gets in terms of the markets, earnings, the economy? Everything seems to be perfect. So we're going to run through all of this and talk about the current risks and talk about how investors should be thinking about this going forward. Peter, let's start out with just the simple fact that everything is up this year, which doesn't often happen if you're looking at stocks, bonds, commodities. Everything is moving up and to the right. S&P 500 here, pretty incredible. All-time high, around 6,400 in terms of the index. You got 15 now all-time highs on the year that follows, 57 in 2024. And what's driving that are many different things, Peter, but I think the biggest one, of course, would be that earnings are very good and that volatility is way back down. The VIX is all the way down to 15. So let's talk a second about those earnings. Another record high for S&P 500 earnings, up about 11% over the past year. And just remarkable, every time you think perhaps there's going to be a hiccup in terms of big tech, Google, Amazon, Microsoft, Apple, we haven't got NVIDIA yet, but the expectations are high, all crushing expectations, driving this S&P 500 earnings number higher. What's your take on the market hitting highs here, the earnings that we've gotten so far this year?
I think the thing is, despite all of the noise and discussions around tariffs and interest rates and regional wars and executive orders that come out every 3 days, the economy is doing really well. Unemployment is low, the consumer is spending, earnings are high, and they continue to go higher. We are in the middle of a tech revolution, of the AI revolution, and we're at the big. I say we're in the middle. We're at the beginning of it, and I think what we're seeing is the winners of that revolution so far are the same winners of the previous revolution that started 20 years ago with the internet. It's the same group of companies that were well capitalized enough to invest the hundreds of billions of dollars they needed to compete with AI. I think this has a long way to go. There will be massive, scary pullbacks along the way, but I think this is a structural change that's going to continue for quite a while.
So in terms of earnings expectations for the rest of the year or for earnings continue to go up, and we've seen a huge investment from the big tech companies, but we haven't really yet seen the results in terms of this adding to the bottom line. At least it's not transparent in terms of how it's doing it. Clearly, it's making workers more productive. Clearly, they haven't been hiring as much the last few years. They're seeing their margins expand because of that. So we're seeing productivity gains. That's driving earnings. But I guess, Peter, the big expectation is ultimately this could mean a lot for future earnings given the huge investment that these companies are making.
Yeah, I mean, I think what we're going to see with AI is, I mean, think about the impact. Forget about the tech companies. Do you think McDonald's is going to pay more or less in personnel going forward? Before, the answer was always more. There's going to be inflation. We need more people at higher prices. I think now everyone can visualize it's soon going to be AI taking your order. It's soon going to be AI prepping a lot of your orders. And you might have a couple people in there all together. You're going to be self-checking in. And I mean, you can do this across just about everything from grocery store chains. I mean, it's coming very, very fast. And I think because of that, we're going to see earnings rocket. The question will be, what does it do to unemployment, which obviously is another extremely significant factor.
Yeah. So in terms of asset classes, 100% positive. We haven't seen that since 2019 for a full year. We're obviously still have a few months to go, but seeing bonds, high yield bonds, everything and in between positive. Very rare to see that. And Peter, I think this chart is simply stunning, given the chart we're going to show in a little bit in terms of the tariff rate and the increase in that. Who would have predicted moving the tariffs up from 2% to almost 20%, that you would have this really explosion in terms of international equity outperformance, leading the world. Very few countries are negative year to date, and really being led by Europe of all places. As you talked about early in the year, pretty much everyone was bearish on Europe, and here we have Greece, Poland, and Austria, and Spain being the top four countries, with the Greece ETF up 70%.
It's so hard to tell if it's got legs. We've had 15 years of the US outperforming international stocks by an extremely wide margin. The year started out before the tariff issue, before Trump is sitting in the White House. International stocks started to trounce the United States, and it's just really never looked back. And it's hard to tell, is this finally regression because the value gap has been so significant for so long? Or does this have legs? I mean, I now have clients asking me, like, should we rotate out of the US and buy more international? I haven't heard that in a very, very, very long time. But look, I think there is a valuation gap between international and US for a reason. I think regulations are tougher, the immigration issues are tougher. Socialism really slows economies down over the long run. I think there's structural differences between Europe and the United States that will maintain a value gap. Plus, you have the AR revolution taking place mostly in the United States. But international has a long way to run, even with all of those things in the way, before it gets back to probably fair valuations. The question is it going to be a straight line or not?
So you're viewing this more as a mean reversion type of thing than investors betting that these tariffs policies are ultimately going to be good for countries outside the US. That wasn't the
No.
intended impact, obviously, at the
No, I
start
think
of
that
this.
it has nothing. I think it has literally zero to do with with tariffs. Has nothing to do with that. It was a story that began before then and has continued on. I'm not big on predictions, but I think at some point in the future, whether it's 6 months from now or 2 years from now, we're going to see the same thing happen with small cap U.S. stocks. There's been a valuation gap between small U.S. and large U.S. for so long again, for real reasons. But especially in an environment where rates may go lower, it wouldn't surprise me to see this same type of enormous run where you make up for several years of underperformance all at once happen in US small cap stocks.
Yeah, let's talk about that unemployment rate that you had mentioned earlier. Still sitting at 4.2%, well below the historical average, 5.7%. And even though we've gotten big revisions, and that was a lot of controversy, obviously, around that, the labor market still appears to be in decent shape, still adding jobs, although fewer jobs. It's seen basically a normalization from where it was a few years ago. When you look at this type of number, you talk about AI. Do you think there's a risk in the next few years of this moving higher because of it in the short run, even if ultimately it will come back down?
I think there's a very real risk that we're going to see a structural change to the unemployment rate that's significant. And I think it might catch some of us off guard. I don't know if it's going to be a year from now or 4 years from now, but I think it's going to be very substantive. And I think it'll be good for at least a couple points that for a long time we don't know what to do with those. And so we have a whole bunch of other things though that might offset that. We don't have a generation that's replacing the boomers, and so you're going to have part of it solved from just the contraction of the population. Second, you've got tight immigration and deportations, and so you're kicking people out of the country, and the greatest generation is on the way out, with the generation replacing them not enough to do that. That might offset some of this, but AI is going to be so substantive, I think, that we're going to see a significant change here.
Yeah. So what's happened so far is basically we've seen supply of labors come down over the past year, but so has demand. And so we're still at this kind of equilibrium in the low 4% area. And we aren't seeing companies yet doing big layoffs. They've just reduced their hiring. So when that flips, nobody knows, but that'll be something to watch, obviously, when they start to say, not only do we not need to hire new people, but we can get rid of existing people because of this new technology. Hopefully, obviously, that doesn't happen, but that's obviously something to watch. And then, lastly, in terms of the economy here, Peter, we had that dip. We called it a technical dip in the first quarter in terms of GDP, came right back in the second quarter, really just a reversal of the tariff impact in terms of net exports, where it was a big detractor to GDP, pushing into negative territory for the first quarter. And then in terms of trade, you saw that deficit come down in the second quarter, and that caused GDP to be 3%. And now we have the expansion, 62 months in duration, so over 5 years. Started, hard to believe it's 5 years already, but started in 2020, obviously after the COVID brief contraction. And we look at the historical post World War II average, you're at 67%. So some people might ask, well, now are we due for a recession? Does the economy have to start to slow down here because of that? What's your response to that type of questioning?
I mean, the last 62 months has not been without its drama, right? We've had two 20% drops in the market, one earlier this year because of the initial round of the tariff war. But as you know, recessions don't spread themselves out. We can never just say we're overdue for a recession. Sometimes you have one and then you have one right after it. And sometimes you can go a long, long, long time, almost a decade without one. So, we'll get one eventually. It's impossible to time. Even the inverted yield curve, which everyone says is the ultimate test, has failed us several times recently. And so, enjoy the ride while it's happening.
Right. Yeah. Just looking at this table here, you could see clearly doesn't have to stop at 5 years. We were at a record 128 months, so over 10 years, longest expansion in history from June 2009 to February 2020. So could that happen again? Of course it could. And at some point, there'll be an expansion probably longer than that last one. So certainly you could see a recession. Very few people predicting it now versus a few months ago. But there's always a chance of a recession on the horizon, which is one of the reasons why stocks have that risk premium, because there's a chance then of earnings contracting and all the rest of it. But let's talk about the Fed here, Peter, because given the backdrop that we just talked about, with everything up and to the right, and unemployment still pretty low at 4.2%, this is kind of shocking to see the Fed is likely to resume their easing cycle. So they cut 100 basis points in 2024, and now they're expected to. The odds are around 90% in terms of the bond market. That's pretty high. The Fed tends to follow those projections. 90% that they're going to cut rates again in September and do at least one more before year end, and then three more in 2026. What do you make of the Fed easing, given all of the charts that I just showed you before?
I mean, it's amazing. I mean, you said unemployment is at these levels, and we're having record earnings, and the stock markets having double digit rate of return. The global markets are even outperforming that. And by the way, what's the Fed going to do? You would not say the Fed's going to raise rates and add fuel to that fire. I think we're seeing that Powell caving in, and the market's anticipating that.
Okay, we'll see. We'll see what happens. Certainly, it doesn't seem to be justified. They always say data dependent. Doesn't seem to be justified based on the data. So maybe there's something else, but there's a lot of data that they're going to be getting, including the CPI report tomorrow. So we'll see how they react to that. And we're going to talk about inflation here and the risks. So what are the risks? What's the counter to everything is up, everything is awesome, the markets can do no wrong? Well, there's always risks in the background, and it's important to just be cognizant of them. So let's talk about probably the number one risk, Peter, which is valuations, which is really surprising because a few months ago we were talking about multiples contracting during that brief bear market, but now they're expanding again, which simply means the market is running up higher than the earnings. So earnings have grown about 11% over the last year. The S&P 500 is up over 20% in the past year. That means the price to earnings ratio is moving higher. I'm showing you a chart here of the price to peak earnings ratio. And that's simply taking the peak earnings in a cycle, taking the current price, and we're at 26.1. That's the highest levels we've seen since 2000, well above, about 50% above the historical median. And if we look at the price to sales ratio for the S&P 500, just this month, we hit a new record high. The S&P 500 is now trading at 3.15 times sales. That's higher than the peak in 2021 and also higher than the peak from back during the dot-com bubble. what do you make of valuations in the US? This is a story we've been talking about for a while now, and now it's back again because prices once again running up faster than fundamentals.
I mean, the stock market's trading, even with all of the good news around AI and rates potentially dropping and unemployment low. The stock market is priced to absolute total perfection. If anything does not go exactly as planned, and you could get a contraction of even 4 turns, and the P ratio goes from 26 to 22, you would see a very, very substantive pullback, obviously, right, accompanying that.
Yep.
And I mean, right now the market just thinks it's rainbows and unicorns, and that's what it's been all year, pretty much. And that's going to need to continue for the multiple to hold. Now, earnings can still grow, and the multiple contract a little bit, but at a slower pace than earnings growth, and you can still have the market go up. This is why you can't say the multiple's high, therefore I'm going to sell until it comes down, because earnings can, going forward, outpace uh, a multiple contraction and still have a market go up during that softening. And I think that's something that catches people off guard. Oh, it's overvalued. I should be on the sideline until it contracts. It can be overvalued, and the economy, the markets can grow into that valuation over time.
And given a long time period, it often does. Right? If we're looking out 20, 30 years, valuation becomes much less important. Over 10 years, when you're at extremes, it tends to mean below average returns. Doesn't have to be negative. It can be, but certainly when valuations are this elevated, what you would say is that you should lower your expectations, that for the future is not likely to be as good as the recent past. But we've been saying that for the past year. And as we've just noted in the second quarter, the earnings from the biggest tech companies continue to exceed expectations. So uh, it's just the fact that the market is even more optimistic about the future than that increase in earnings. So historical earnings growth, Peter, is about 6% for the S&P 500. We're running double digits here. So very strong earnings growth. It's just that the market is thinking that either the future we're going to see 20% earnings growth or 30%. Perhaps they're starting to price that in. And as you said, it's really a perfection type of situation where if anything falls short of that expectation, then you leave the market vulnerable. But talking about another risk here, and this is one, again, we were talking about all of last year, but it's continued once again because you have these big tech companies, particularly NVIDIA and Microsoft. Apple's actually lagging a little bit this year, but if you combine the three of them, now over 21% of the S&P 500 just in these three stocks, NVIDIA, Microsoft, and Apple. NVIDIA being the largest at 8%, Microsoft 7%, and then Apple after that. We've never seen concentration in the index this high. If you look at the top 10 holdings, you're at over 38%. How do you view concentration risk at this point?
I mean, it's very real. I mean, 21% across three companies, 8% just Nvidia, almost 50%. If you take the eight top companies, we've never seen concentration risk like this. But I also think that the risk, I perceive it a little bit differently. Some of these companies, this isn't like when 20, 30 years ago, one company did really great and they did one thing really well, and then somebody came along and made them obsolete, kind of the Netflix blockbuster scenario. This is a world where these are like entire economies, right? It doesn't mean they won't be disrupted someday. They will be, or that they won't give way to other companies someday. They will be. But this is probably the first world where you could say, hey, would I rather own Microsoft or the bottom 50 companies in the S&P 500? I mean, you might probably rather own Microsoft. It is crazy to say one stock versus 50, which one's safer over a decade. It might be Microsoft. We really couldn't have that kind of dialogue with the previous kings of the hill. And I think these have become entire ecosystems, entire economies in and of themselves. Some of these companies you would rather own than entire country, like all of the stocks in an entire country. And I think that's what's changed. I'm curious your thoughts on this, Charlie. You've been tracking, I know, on X and a lot. You've been tracking the concentration risk. You don't comment about your feelings about it though. What do you think?
Yeah, what I often do is try to be objective about it, and so really what I compare it to is the underlying fundamentals and earnings, and it's above that. So this week I'm going to put out on X a bunch of charts, kind of comparing the two. So what is the weight in terms of their earnings on the S&P 500 versus their weight? And their weighting is higher than their earnings. And that could mean two things. That could mean that the market just is ahead of the fundamentals and those fundamentals are going to come, or it could mean that investors are overly optimistic and assuming that the high growth rates in these companies are going to continue. But my takeaway for an investor is the same as what we've been saying the past few years. It's not that you don't want to own these companies. You want to make sure you own other companies as well. If this situation were to reverse, you'd be in trouble if you're really just concentrating in these few companies. And it just means if you're simply owning the S&P 500, just based on math, you're less diversified now today than you've been ever before. So to me, that just strengthens the case for international investing. You mentioned small caps. We have almost a record high in terms of large caps to small caps. A lot of people are down on small caps for good reason. Earnings growth have trailed large caps now for over a decade by a wide margin, but I don't think now's the time you want to kick them out, just like last year wasn't the time to kick out international. So my response for investors is just make sure you're focused on that diversification, because we don't know when this trend changes. It could even become more concentrated. Look, right? If the fundamentals continue and the pricing power of these companies continues, that's really what it's about. I mean, Microsoft earlier this year, Peter, as an example, Office 365 is a product that most companies use, many individuals. They just raised their prices 20%, and saw very little attrition, right? And just so their ability to do that, and they said we're going to give you some AI, we're going to give you Copilot as a as an add-on there, but uh, the ability to do that because it's so ingrained in the system is just unbelievable, and that flows right through, right? Because it's software, flows right through to the bottom line.
That's right. And it'll be interesting if the AI that is now totally controlled for the most part within these companies winds up becoming the demise for some of them. And I think that's going to be interesting, particularly with Microsoft, I think.
Well, it's the parallel, right, to the internet build out infrastructure, and we've been talking about it. But just like back then, we didn't know when that cycle was going to turn. Is is there over investment? And it seems crazy right now. How could you be over investing in something that's so revolutionary and powerful as AI? But it's just stunning the amount that these companies, and look, they have plenty of free cash flow to do so, to make these investments. The question will be in the next 5, 10 years, are they doing it too soon, right? Before the technology is changing so quickly that it becomes obsolete very quickly. And if there's a change in the cycle, in terms of there's a recession and downturn, all the rest of that, will that be problematic? Like it's impossible to say, but that's definitely a risk as well. And given the investment they've made versus other companies, like they're getting the disproportionate gains, but they would get the disproportionate losses if and when that cycle were to turn. But let's talk about the inflation risk here, Peter. And I still think it's present. Like as much as the Fed can talk about, they're close enough to the target, I think is what they're going to say, close enough to cut rates again. But we're at 2.7% over the past year. The expectation is, even from the Fed themselves, Peter, is that this is likely to go up in the next few months, which is really remarkable because you almost never see the Fed easing when their inflation expectations are moving higher, moving away from their target. And really, if you look at since the Fed enacted their 2% inflation target, which was 13 years ago, we look at any time period, there's been 2% inflation is a myth. We're not, and this is assuming, right, that you believe the government numbers. I know many people think inflation is actually much higher. I would agree it's definitely higher. How much higher, we don't know. But even using their own numbers, there is no 2% inflation. And if we look at the past 5 years, we've more than doubled that 2% inflation target. And if we talk about tariffs, I think there's a little bit of that mission accomplished in terms of we haven't seen a big price increase whatsoever so far. So we're not going to see a price increase. But that, as we'll talk about it in a minute in terms of the data, that could just be a delayed reaction because of the way things are playing out. What's your take on inflation here? Do you think there's a risk of it moving up? Particularly, we're still running deficits. Deficits are likely to increase. As we're talking, the national debt is hitting 37 trillion. Is inflation at 2%? Is it still a problem?
I think inflation's always higher than the Fed says it is. I think the government numbers are always off. I think it always hurts the consumer more than they indicate. And I think that we're going to continue to see more than 2% inflation simply because of the deficit spending. You can't throw this much money at everything and not expect prices to go up. I mean, the other side of that is AI, and we keep coming back to this, and how it might change things. You go to McDonald's, instead of 40 people back there, there's four. They're no longer going to have to pass all those labor costs through to the consumers. So I think we're going to see higher than normal inflation, higher than the Fed indicates, for quite some time before AI comes in and starts to alleviate some of this.
Yeah, I agree. My guess is at some point, Peter, they're probably going to say, forget this 2% target. Let's move it up to
Right.
3% or 4% because it's just going to be too hard to meet that 2% inflation target. But let's talk about tariffs here. And if I showed you this chart at the beginning of the year and said tariff rate's going to go from 2% to 19%, you would have said for sure that chart I showed you of global equity returns it's impossible that that would be real. But here we are. And the big question is, have we seen the ultimate impact here? Again, stocks are at all-time highs, Fed's easing, the market's behaving as if this is going to be a net positive or at least irrelevant. And the question is, have we seen that ultimate impact in terms of, are we going to see consumers pull back in terms of their spending if prices go up? And I'll give you my take first here in terms of the data. I think it's all distorted by that front running that we saw in the first quarter. What I'm showing you here is the US trade deficit. And the primary objective, I think, if you ask a lot of people in terms of the tariffs, is to reduce the trade deficit, right? To balance the trade. And what happened was the exact opposite in the first quarter of this year. You can see these numbers over here, this huge spike in the deficit. And that was because US companies were front running that tariff rate. So why pay 20% or 30% rates for goods? I'll just buy them now in advance. And that pushed out the deficit. That caused that first quarter GDP to go down. And we're actually the deficit first 6 months of this year over 30% higher than the first 6 months of last year. So my big question is, well, what's going to happen when those inventories are depleted to the point where they have to replenish them? Is that when their companies are paying higher prices and you're going to see the result? Because Peter, it's I think we're talking about now 30 billion in terms of monthly tariff revenue. Who's going to pay that 30 billion? Certainly it's not going to be all one group, but part of it's going to be paid by that overseas seller, part of it's going to be paid by the US company importing that good, and part, unless history, it's different this time than the rest of history, part is going to be passed on to the US consumer. So I threw a lot out there. What's your current take on where tariffs are, knowing that it seems like it changes every single day, and we've been saying that for a while?
Yeah, I mean, you're right that the consumer isn't feeling it yet, because Goldman Sachs just came out with a study researching who's paying for these tariffs, and it's exactly like you said. Some of it's being borne by the seller, but really what's happening is companies are just eating it and not passing it along. They're not repricing their goods fully onto the consumer. Less than 25% of the tariffs felt by the consumer, but basic economics tells us soon that will have to be closer to 100%. Right now, companies are going, look, there's more. I'm not going to change the price, and people are used to buying it at this price, and I've got competitive pressure. So you keep the price where it is, you eat it, you're not profitable for a while. If this was really the new normal, those costs will eventually be passed on almost entirely to the consumer. Everything that's coming to the country would go up in price. Major tax on consumers, disproportionately impacting the middle class and the poor, be extremely negative for the economy. We're just not feeling it yet. We'll see where we are in 4 or 5 months.
So your best guess is that we're going to see higher prices. Consumers going to have to bear that. And do you also think along with that we'll see a reduction in purchases, a reduction in trade from this?
Yeah, I think my best guess is we're going to see most of the tariffs negotiated out and rolled back, but that we'll still wind up with tariffs that are too high, like 10, 15%. that those will get passed through the consumer. We're going to see higher prices, and it will negatively impact the economy. That's my there's a lot of guesses in there. I'm not big on predictions, but if I had to guess, that's where I would go.
So I think the follow-up question to that, Peter, then is, will the administration be flexible enough to change that policy if they start to see what happened in April again? So we have that history that they reversed course very quickly when the markets revolted. They start to see that again. I don't think it's out of the realm of possibility to say they'll come back and cut these things or
100%.
tear them up.
They'll declare victory. We negotiated some new deals, cut them. No, absolutely. The one thing the administration's shown is the ability to pivot sometimes twice in one day. Right. So I mean, I don't think it's too big of a stretch to assume if we get the negative outcome that they just change direction.
And then there's also the curveball of the courts could invalidate some of this as well, and maybe not all of it, but part of it, and that would push it lower to out. So perhaps no one knows what the market is thinking, right, and its pricing, but perhaps that's why the market is being so optimistic because they're of the belief that none of this stuff is permanent. That's my belief. Ultimately, if it ends up being okay, and we're just as just a revenue generator, and there's not a huge impact, then they'll keep the tariffs. But if there's any negative impact, if they're not rolled back by the current administration, they'll be voted out of office. And the
Yeah.
next, obviously, the platform for the next presidential election will be all about, we're going to get rid of the tariffs, we're going to lower prices, we're going to increase economic growth. And so I don't think that's something that the current administration is going to want to see. So my best guess is if they start to see this play out in a negative way, they're going to reverse. But as we just talked about, it could take months, it could take a year to see this impact because companies, as you said, will wait as long as they can before passing along. They don't want to risk losing the customer. And I think this really benefits, Peter, disproportionately bigger companies. So like Walmart has the luxury, right, of waiting much longer than a small business in terms of passing on that cost, right? A small business, lower margins,
That's right. I mean,
much more
the S&P
pressure.
500 companies are they're going to survive this just fine. It's and I work with some of them. It's the smaller companies that are really, really suffering right now.
Absolutely. And so there you go with the small caps underperforming this year. Certainly there's a fundamental reason for that. Okay, let's go to investor takeaways here, Peter. I just listed 5 different takeaways, but number one, I would say in response to the concentration, in response to the uncertainty, diversification is always the answer in terms of we don't know what's going to happen in the future. We don't know if these existing companies that are leading are going to continue to lead. And we just talked about simply owning the U.S. market. You're more concentrated, so make sure you're diversified.
Yeah, I mean, diversify now. If you think you got too much risk today, don't wait for a down market. This is the time to visit diversification when you've got strengths. If you've seen some of these runaway stocks that are doing really well, resist FOMO as you outline here and stick with your plan. I mean, even within your plan, you're going to wind up with some concentrated risk. Definitely lower your return expectations. You can't expect international stocks to be up over 20% a year and US stocks to keep posting double digits every year. This is abnormal. What is normal is the stock market to do 8 to 11% everywhere across the world over the long run. And along the way, be prepared, like you write here, for a correction. Market's going to drop about 10% or more about every year and a half. Another one's always on the horizon. Don't ever get too comfortable.
Yeah, it's never even or orderly, or there's never any. No one rings a bell when that's going to happen. But we do know, based on history, that it would be pretty rare. It's not impossible, but it's pretty rare to have that 20% correction that we had back in April be the only sizable correction. My best guess, just based on history, is that there's another one coming. It may be for the same reason. It may be tariffs, maybe something, but that we're not talking about probably will be something we're not talking about. But just make sure you're prepared for it. And if you look at the last 5 years, Peter, U.S. stock market has doubled, and the bond market is down. Right. So if
Yeah.
you just have a simple stock bond portfolio, you have a lot more stock, and that's been a very good thing. And that might be fine if your risk tolerance and you can handle that. But if you can't handle it, now is a much better time to panic than when the VIX is at 60. Please don't wait for when everyone is panicking and selling. When the market's all-time high, it's a perfect time to ask yourself, well, how did I think about that 20% decline back in April? If you were nervous about it then and you saw that big decline and you were thinking about selling, well, now's the time to actually make that change so that you won't be tempted to do something during the next correction. All right. Covered a lot of ground there, Peter. Just a reminder for everyone, our Connect 25 events are here in full force. We got Seattle, Omaha, Denver, Atlanta, Tampa, Miami, Fort Lauderdale. I'm going to have a link in the show notes. Please join us. We're going to do a live signal or noise at all of these events, so we hope to see you there. And it's been a great episode, Peter. Good conversation. As always, covered a lot of ground. Hopefully this is helpful. Thanks everyone for watching. Subscribe to our YouTube channel. If you're not currently subscribed, get all of the latest content from us. Hit that subscribe button, and we'll see you next time on the next episode of Signal or Noise.